I'm super excited to welcome an institutional LP who is a leading investment manager, and his fund is pioneering in investing in emerging and diverse fund managers. They have an asset under management of $9.7 billion, and they have been investing in venture capital industry since 20 years. He's a partner in the fund and involved in all the firm's partnership and direct co-investment portfolios. He has previous experience with startups, venture capital, and consulting. Welcome to SheVC. I'm your founder and host, Gayatri Sarkar. So today is a special day. We have Aakar Vachhani. He's the partner at Fairview Capital with us today. Super excited to welcome you, Aakar, on SheVC.
Hey, thank you, Gayatri. Really great to be here. It's been awesome to see the conversations you've been having, and it's looking forward to be a part of them.
Yeah, a big shout out to Jessica for introducing us. And I think Fairview has been a leading pioneer when it comes to investing in emerging fund managers. So you have been an investor in the private equity and venture capital markets from the limited partner side. How has your investing experience in early stage venture capital funds and emerging fund managers shaped your investment theses in the private venture market?
Yeah, so I think the areas that you're focused on and interested in are to us the most compelling and attractive and interesting segments of the private markets. Fairview's a fund of funds manager, and at the core, this is what we focus on. It's where we have expertise. It's how we add value to LPs. And, what the data will tell you is the best performing funds are typically in venture, and they're typically emerging managers, new firms and smaller funds. But it's hard, right? There's a high dispersion of returns. So manager selection is really important. There's a lot of pitfalls when it comes to this part of the market, potentially for investors. But at the end of the day, if you can invest with the right managers, it can be really rewarding. And I think, particularly where we are today, I mean, as the private markets have grown, as they've evolved, there's more capital coming in to the market at the later stages and in larger funds. And we think, that's pretty obviously led to more competition for deals, higher valuations, and really less differentiation at the later stages. And capital in some ways has become a commodity. And when you look at the earlier stages, it's very different. And then that's where most emerging firms, tend to focus. We think there's going to be continued, value add and the ability for these firms to create tremendous value, particularly when you think about coming early as these companies are staying private longer, in part because of, there's the fact that there's so much later stage capital. So, we have always been bullish on early stage venture and emerging firms, and we'll continue to be.
I love that. So you have been in the industry for quite some time. Can you elaborate about the new market opportunities with diverse managers in private equity and venture capital, and how do you think the market has changed in the last 5 years?
Yeah, so diverse managers is something that is very important to Fairview. If you know anything about us, that's why Fairview was founded, and it's been a core part of our DNA for the last 25 plus years. We go out and build, just for context, we go out and build portfolios for LPs, sometimes that explicitly focus on diverse managers, and other times where we just know that it's important to our LPs, and there could be a whole continuum kind of in between those two extremes, if you will, around diversity. But it's an important part of what we do. And as a result, we've been tracking diversity in the industry and diverse managers for a very long time, probably longer than any other firm. And our goal is to see every diverse manager in the market every year. And we think we get closer to that than any other institutional investor. So we think we have good data, on the trend. So that's, something that's easy for us to speak to. And, if we look at, I think it was the last 5 years that you were more interested in, the market has really exploded. When you look at women and minority-owned firms in the country, they've increased by 4x in number over the last 5 years. The CAGR is like 30% or more. But when you so that's great, right? There's tons of opportunity, tons of firms doing great things. But you know, look deeper. There's some really interesting trends within that. One is that it obviously is a very much an emerging manager story. 93% of the firms that we see in the market that are diverse are either funds 1, 2, or 3. And in fact, the majority of the funds, I think over last year was over 53%, were literally first-time funds.
Yeah.
They're smaller funds. It should be no surprise. I think the median fund size is around 100 million, and that's across private equity. It's smaller in venture, of course. And when you look at the private markets broadly, about 70% of all diverse managers are raising venture funds. The vast majority of women in in private equity are raising venture funds. So given all those dynamics, while there's great opportunities, we think the market in some ways has gotten more complex for larger institutional investors, because it takes way more intentionality to engage. Given the profile of these firms, they don't have traditional fundraising processes, right, that large institutions are used to. So, these firms aren't doing big road shows. They don't have placement agents, and they don't even necessarily do road shows with consultants. So, you as an LP, you have to be more, you have to be more thoughtful about how you source these managers and meet them. And then even when you're doing that, I think, what's different for a lot of institutional LPs is that you're not only evaluating a fund, but you're evaluating the firm, right? These are entrepreneurs. I'm talking about the managers. They're entrepreneurs building businesses, they're firms. And in some ways, it's no different than a VC evaluating a startup, which is to say that it's very hard. And on top of that, you have to be programmatic about it. You have to take a portfolio approach, because we think there's still a lot of idiosyncratic risk associated with even one fund. There's a high dispersion of returns. So you want to be diversified, and that's again where the intentionality comes in. So again, you may think that the growth in the market has made it easier for larger institutions, but in a lot of ways, I think it's become harder for them to navigate. And I think maybe we'll get to this at some point in the conversation, but I think it is really important for diverse managers to be able to unlock these pools of capital from larger institutions.
Yeah, totally agree. And I love what you said, the dispersion of the capital. And I want to go a little bit off the script and ask you this question. How do you source and evaluate these fund managers, especially the emerging fund managers?
Right. I think sourcing is really important. And like I said, we try to see every diverse firm in the market every year. And it's with a ton of intentionality. So for one, we're just known investors in the category. So we get a tremendous amount of inbound deal flow. You have a known open door policy. And that I think is really important. You don't want to be exclusive in any way. You want to be inclusive. So we'll take meetings with any manager, even if it may not be an immediate fit. And I think having that reputation is really important. Again, drives great inbound deal flow, but as any institutional investor will tell you that, you can't just rely on that. So even if you have some of the best inbound deal flow in the industry, you're still going to want to be proactive, right? And especially with diverse managers, you need to. So the things that we do that have been successful have been, one, engaging with industry trade organizations. So groups like the NAIC, Women in Private Equity, AIM, NASP, the groups like that emerging managers turn to for advice and support, and oftentimes look for, to provide LP introductions. We're in a part of all those organizations. We've helped found some of those organizations. We're in the boards of those organizations. So we try to stay really embedded in the emerging manager community. Other ways that you can do that is, we have our own events. We try to be thought leaders. Try to maintain a brand that is open to emerging managers. And then the last part of it is, just doing your research. So, we have a great database of managers, but we're always looking to enhance it. We use research to help do that. One interesting thing that we've found over the years is that emerging firms kind of develop in clusters. So it can be around a certain geography or a certain investment theme or a certain sector. And that's been a rich source for sourcing for us. So, we identify a theme early, and it's not uncommon to see a lot of new managers pop up around it. And we've done that around like the LA ecosystem, for example, certainly with institutional seed funds, around AI, for example. So look at big trends, and if they're big enough, sure enough, you'll find that there's firms that are forming around them. So that's an example of using research to help source managers. And then, of course, we subscribe to like third-party databases and things like that. But that's kind of a last tool for us to, things like PitchBook, et cetera, that can help kind of fill in your database. But that's kind of the last thing that we use. So it takes an all-encompassing effort to really, effectively source managers in this space.
Yeah. And what kind of track records you're looking at? Because sometimes they do not have any track record. Sometimes maybe the first time fund managers who have never worked in another venture capital fund, or they don't have any track record as a founder also, but they decided this is something very close to their heart, and they are very closely connected with the ecosystem. So how do you evaluate such fund managers?
Yeah, I mean, there's a lot that goes into it, right? No surprise. And I wish it was easy as just like one answer, but it depends, right? Every firm is different. Beyond just the firm itself, we're also evaluating fit and where we are in our portfolio construction, all that. But when it comes to the firms that we're looking at, I mean, the most important thing for us is the team, right? And there's lots of elements. There's team cohesion. There is their reputation. Their individual brands and the brand of the firm within the entrepreneur community and the venture community. So those things are really important. The type of culture that they're trying to build, those are kind of maybe understated often, but I think end up being the biggest determinants of success. So we spend a lot of time on team. There's plenty of people with great ideas, great strategies, and that are very smart. But I think what ends up differentiating the best firms from the other firms is that they're able to they have great deal flow, and then they're able to win deals because of their reputation. And so we spend a lot of time looking at that, the ability to source and win deals. And then there's kind of an intangible around grit and determination around building the firm that I think is important. Fundraising is hard. Building a new firm is hard. You really have to stick with it. There's going to be a lot of ups and downs. So that type of character assessment around, does this team have what it takes to build an enduring brand that can consistently attract the best entrepreneurs? And, we found over the years that some of the best firms start out by doing that in a way or in categories that maybe aren't so obvious, right? But over time, when you look back, they seem obvious in retrospect. And these firms, can over time end up in dominant positions from a brand and reputation perspective, even if it isn't there early on. So sometimes we're just looking for the seed of that. But if they are successful in what they're doing, that can ultimately create this virtuous cycle, which will kind of in turn help them continue to win the best deals. So that again is kind of an intangible type of thing, but something that we try to really get a good feel for. Is this a firm that can harness that type of effect and build this sort of flywheel over time that can really lead to enduring success?
Yeah. And just an extension to that question is that venture capital is all about identifying patterns in time. So what is the pattern matching that you do with Fairview Capital when it comes to investing in those emerging and diverse fund managers?
Yeah, I think, in some ways it can be dangerous to try to, just match patterns because, what I can tell you with certainty is that what led firms to be successful 10, 15 years ago probably are not the same exact elements that you need to be successful over the next 10 to 15 years. So, it's a constantly evolving landscape. I think what it takes to be successful is constantly changing. So that makes our job tough. But, pattern matching, I think, would be along the lines of, to the extent that we do it, or it's kind of broad in general, along the lines of the things that I talked about. I mean, around the quality of the team, the reputation, their deal flow, the ability to win deals. Track record certainly is important, which I guess I didn't hit on, but it's somewhat intentionally, because there's a lot of people with great track records. It's kind of the other things that set them apart. But when we're looking at emerging firms, sometimes there isn't a track record, or it's very nascent, and so we're doing that second order work of talking to the entrepreneurs and really digging into the companies, looking at the co-investors. I mean, that sort of thing is still very important.
Yeah.
And so that does kind of play into pattern matching, if you will, a little bit, especially with emerging firms. But there's no, we build out these diligence plans for every firm, that we dig into, and I will tell you, no one plan is the same. So it does take some flexibility, but having that historical context certainly is very helpful for us.
Yeah. And my next question is something which is very close to my heart, because I have faced these issues and seen these issues from both the sides. So the dollar amount that is allocated for emerging and diverse fund managers are minuscule. Sometimes they are pushed into focus funds, sometimes they're pushed into diverse fund mandates. And do you see more institutional investors moving into this new class of early stage emerging fund managers?
Well, I think for sure, right? And I think this year, especially with the whole social justice movement, there's been an acceleration. There's more interest in diverse managers, and I think that's great. I think there's efforts kind of beyond, and that, by that I mean just interest, from institutions in learning more and wanting to do more. And I also think over the years there's been building of efforts like yours that have been great. I mean, helping to highlight the opportunity set, push the conversation to the forefront. You engage key people over time that way, and there's a number of initiatives and organizations that are doing this sort of work, and I think that is incredibly important. But that said, I think we're still a ways from truly unlocking capital at the highest levels from larger institutions, which I think is the ultimate goal. When I look at the market today, while there's a ton of genuine effort and genuine kind of activity, there's also a lot of, unfortunately, like token commitments or one-off investments. And I think what's needed is for these institutions, and I'm talking primarily about public pension plans, large foundations and endowments, to be more serious, to be programmatic, and commit to the category long term. And that takes hiring the right staff or partners, and building a practice around this. And I think there's still too few investors that are thinking about it in the right way. And there are a lot of challenges. I think for investors kind of looking at those sources of capital, it can be daunting, right? You're facing a lot of explicit and implicit bias. There's incumbency bias. These organizations, are usually tend to mess with the firms they've backed in the past. There are structural issues around the check sizes being a fit. And I think there continues to be this lack of alignment that exists too. And when you think about these large institutions, the way it plays out is you typically have to convince the staff, the board, and a consultant. And maybe the influence and the power that one of these groups has can vary, but in general, you have to convince all of them, and it's hard. You find sometimes the consulting firms are not aligned. Their goal is generally to just get a new contract and generally averse to risk taking or perceived risk taking.
Yeah.
The boards of these organizations, often are not as diverse as I think they should be. And then on top of that, the understanding of the market really ranges. So education ends up being important around the opportunity set. And then when it comes to the staff, you find that a lot of times they don't have the capacity to dedicate time to this segment, or they aren't incentivized properly. And then the big thing that hangs over all these challenges is the perception that investing with diverse managers is still some sort of social thing or an ESG investment, when in reality, diverse managers are proven to outperform. and small firms and new firms also outperform. And you still, even in conversations we have this year, you often hear the excuse that sounds good. Um, yeah, and so that I think that the big thing that hangs over all these challenges that exist is also this perception that investing with diverse managers is some sort of social thing or an ESG investment. When these managers have proven to outperform, you often hear the excuse that investing with diverse managers doesn't align with an institution's fiduciary responsibility. I mean, even in conversations we've had, recently, in the last few months, we've heard that, and I think that's the narrative that has to be flipped to really unlock institutional capital at the highest levels to really move the needle on the capital that's available for diverse and emerging managers. So yes, I've seen more activity this year, but I think there's still a ways to go, truly leveling the playing field.
Yeah, you kind of answered my question when I was supposed to ask you, but I totally, nailed it, that these are the systemic changes and the programs that are required. But I would love to know a little bit about this on the program side that are required for the institutional fund managers to raise meaningful capital in this asset class.
Yeah, I think, so, I mean, yeah, going back to trying to unlock capital from the highest levels and the largest sources again, so pension plans, larger foundations, endowments. Um, we do need to create this alignment with they know their fiduciary responsibility to be, and we need to fight some of this bias that exists, the implicit bias, incumbency bias, the structural issues that exist, and I think some of the ways that we can maybe do that, one, start with education. And I think here the industry organizations do a good job, right? The NAIC, NASP, AIM, et cetera. They're pushing to educate these boards and the staff members on the opportunity set. There's so much more work to be done on that front. So, to any of the fund managers that are, listening to this, or certainly the LPs, take a look at these organizations and see how you can participate and get involved. They are doing some great and really important work. Continued push for more board diversity. I know these conversations are happening at various levels across the country on various fronts, but they also apply to the board diversity of these institutional investors. And then just continued dialogue, I think, with these groups, is really important. As often as you can have them. And I think the big thing that will help change things, is continued outperformance. Continue to do well so that these institutions just can't continue to ignore the opportunity, and they're motivated to participate more than just superficially, because they'll be missing out on some really great returns. So those are some of the things that I can think of.
Yeah. Absolutely. And I want to mention a few things that, in the perspective of COVID-19, a lot of this diverse, focused fund management programs, I mean, they had been canceled, and they have been canceled because of what is going on in the industry right now. And I would love to know, your take on, has your risk profile changed over the years, especially now with COVID-19? And do you also think there is an important need for time diversification and vintage year, especially when you're thinking about venture-oriented portfolio?
Yeah, great question. Certainly we have heard a lot of institutions, have become a little challenged with the pandemic and the market fluctuations and illiquidity at times. Have all been reasons why. We've heard some institutions have had to pull back from making commitments to new managers, and unfortunately, in times like this, it's typically those commitments that are pulled back on, which is why we think it's really important to be programmatic. So if you have a program in place, you have an allocation for diverse and emerging managers, and you're constantly looking at forced to look at new managers as part of your investment policy, that is really helpful. As a fund of funds, we kind of do that by default. And so it's been easy for us to stay in the market, but we understand, why other institutions may not have been. So having a program in place, I think, really helps address that. We've seen some large pension plans and others that have an emerging manager program, not be as impacted, for those reasons. And then when you think about, the other thing that a program really helps is that over time, you will have a continuum of funds, and so you're always in a position, you have that vintage year diversification that you mentioned, which is so important. And in times like this, it's helped because we've got some mature funds that we've, invested with maybe 5-7 years ago that are in the position today to generate liquidity, and in fact, significant liquidity. And so that's been important. And, when you look at it in the portfolio context, that, will help kind of solve some of those reasons that some institutions may not be able to invest today. And I know it's tough, saying in retrospect that, maybe you should have invested 5-7 years ago, but I think you need to, at some point, commit and start building a program. And then you won't have these issues in the future. And the other thing is just, with respect to COVID, I mean, you shouldn't, we think the best practice is to not to try to time the markets, especially the private markets, especially venture. It's very difficult. These are long-term investments. Even a commitment today is, going to take you out into 2023 in terms of the investment period. And then those companies are not going to mature until the late 2020s. And you can't predict, what the markets are going to be. So if you just invest with the best managers, with the best strategies, with the best deal flow, consistently over time in a disciplined way, you will find that you can be successful.
Wow, I love that. And I think there are so many different takes and things that are going on during this time. But I would like to ask you a few fund management questions, especially you're on the other side. And by recycling, GPs are extending the capital pool to deploy. So can you elaborate how this strategy works and how does that benefit LPs?
Recycling, yes.
The management fees,
Yeah, recycling management fees and recycling capital and funds. Yeah, we certainly during COVID, we've seen this as a tactic that managers have used to extend the life of their funds, extend the amount of capital that they have to deploy. And in general, we think it's a good best practice. Usually it's about 10 to 15% max of a fund's commitments that can be recycled. And we think, it's a huge advantage actually when you do the math at the end of the day on the TVPI and DPI in the long run. These are the multiples based on paid in capital, right? So you're kind of leveraging that by recycling, and you'll have an advantage over your peers who may not be recycling. So we think that's important, and certainly during COVID, it's an important tool. If emerging firms don't have the ability in their LPAs to use recycling, we've heard and seen managers come back with an amendment to the LPA that does allow it, and LPs will be supportive of that. It's very favorable to them. So we would encourage that. And it also just helps align interests really well, right? So GPs are kind of aligning themselves, not reserving for fees within the fund, in fact, going beyond and deploying capital beyond that. So we think it's a good tool to also better align interests with LPs.
Yeah, totally agree. I would also like to know your take on, when people on the fund side, they're distributing cash versus distributing public securities. And do you think that benefits the LPs? And what's your take on that?
I mean, we'll take any distributions we can get. We're not picky. I mean, distributions are distributions. For us, we're a fund of funds and we're comfortable taking both. We've gotten, this past year, it's actually a pretty even split between stock and cash distributions. I was just looking at our most recent liquidity report. So we're comfortable with both. We have a whole process in place to liquidate. So we don't hold ourselves public securities and we're not a public manager. So we'll liquidate immediately, or if it ends up being a larger position, and we have a whole policy in terms of how we do that over a relatively short period of time. But what that means is we only distribute cash to our LPs, which I think, for some of our LPs, they're just not, in a position to accept, public securities, or, prefer not to. So I can see why, for some folks that could be a concern, but for most fund of funds, like Fairview, not a concern, kind of really either way, cash or public.
Yeah, I love that. I would also like to know, like, what are the biggest misconceptions that you're seeing about venture firms currently, particularly towards emerging fund managers?
Misconceptions around firms. So I think, definitely around the risk, right? That has always been a big misconception, that these managers are risky, venture is risky. And yes, there is an element of risk, but again, I think they can be addressed by being programmatic about how you invest, taking a portfolio approach, and you can really diversify away a lot of that idiosyncratic risk associated with any one fund. If your approach is, I'm going to do one fund a year that's emerging, that is extremely risky. We wouldn't recommend that. Some of the other misconceptions, is around the complexity of the market, right? That it's too hard. There's too many managers. I don't know where to find the best ones, or I don't know how to evaluate them. I don't have the time. It's not worth my time. That all that stuff. I think that is a big misconception, because if you dedicate the time and effort, which I acknowledge is hard, you will find that you will find some really fantastic managers. You will, if you do it right, you will be able to generate fantastic returns, and it just, it will take more effort, but the rewards will be there. So risk and the complexity around it are probably two of the bigger misconceptions that I hear about.
Yeah, and so my last question to you, before I let you go, what advice would you give emerging fund managers right now?
Certainly be aware of I hope this wasn't too negative in terms of the challenges that exist in the market, but certainly be aware of the challenges that you will face when you're going to be trying to raise institutional capital. The good thing is that there are plenty of good sources of capital. There's plenty of interest. So stick with it. It certainly takes persistence, but it will be challenging. I think it is always hard to raise capital, and when it gets tough, I think it's important to remind yourself about why you're doing this, right? Channel some of that energy that motivated you to launch your own firm to begin with. Something, there was certainly an itch that you had to do this, something that drove you and motivated you to want to launch your own firm. And part of that is being entrepreneurial and having that grit, and sticking with it. It's hard. It takes a long time. You have to be persistent. You have to be resourceful. All those things. I know it can sound like a cliche, and everyone's probably mentioned it, but it is so very true. Beyond that, I would say it's probably important to be, especially in times like this, sure about your strategy. Be clear about what your edge is. Execute, on your strategy, regardless of where you end up with on your fundraise. Even if you don't get to your target, it's important for LPs to see you, building and executing. And then the other thing too, sometimes we see managers kind of get caught up in their portfolio, but don't forget, you're not only building a portfolio, you're building a company and a firm, and don't forget to pay attention to all that. And everything that goes into it, and especially around culture and team and communications with LPs and all that stuff. It is very important. But stick with it, and stay positive, and be persistent and resourceful.
Thank you very much, Aakar, for your time. I think this is an excellent source for a lot of institutional LPs and for emerging fund managers to understand, how to be a part of a programmatic solution when it comes to emerging fund managers and diverse fund managers.
Yeah, for sure. And happy to be on. Thank you so much for inviting me. And I would just a quick, plug for Fairview and that, if any managers are listening to this, feel free to reach out at any time. We are, like I said, an open door. So, we always look forward to connecting with emerging managers.